If your savings goal is $20,000, banks actually don't like that. That probably sounds irrational at first, doesn't it? After all, most people assume banks want as much deposited money as possible. But the reality is different. Their biggest profits do not come from people with large, stable balances. Their biggest profits come from people who run short on cash and are forced to rely on financial leverage. Once you reach the $20,000 mark, you unintentionally enter a kind of immunity zone against many high-interest lending products. And that is exactly when banks begin losing a massive stream of profit that would otherwise come from your pocket. Let me show you why $20,000 is such a powerful number, and why, from the perspective of financial institutions, it can be such an inconvenient one. What does the $20,000 mark really mean, and why is it so powerful? For many ordinary working people, $20,000 is a major financial milestone. It acts like a cushion that keeps life from being thrown off course every time an unexpected problem appears. To understand the real power of this number, take Bobo as an example. He has a stable job, earns enough to cover his monthly expenses, but has almost no savings. Then one day, his car suddenly breaks down in the middle of the road, and the repair bill comes to $1,500. At that moment, Bobo is trapped. If he pays to fix the car, he may not have enough money for rent that month. But if he does not fix it, he has no way to get to work. A single unexpected expense is enough to throw his entire month into chaos. That is what life looks like without an emergency fund. Any surprise, no matter how small, can quickly turn into a disaster. Now imagine the opposite situation. Bobo already has $20,000 in his account. The car still breaks down. The repair still costs $1,500. But this time, the situation is completely different. He opens his banking app, transfers the money, and gets the car fixed. The problem is still annoying, but it is no longer a financial crisis. That is the true power of the $20,000 milestone. It can turn life's hardest punches into manageable inconveniences. It may not make you rich, and it certainly cannot solve every money problem, but it can give you something incredibly valuable: stability, control, and breathing room. Why banks don't want you to reach this milestone? Once you build that $20,000 financial shock absorber, your relationship with the financial system begins to change quietly, but fundamentally. In reality, banks do not hate the fact that you have money. In fact, they are perfectly happy to keep your deposits in their system and use that capital in their broader financial operations. What they do not want to lose is their ability to profit from your small mistakes, especially during moments when you are short on cash and have no real option except to accept high fees, expensive interest rates, or unfavorable terms. To understand why banks would quietly regret a customer reaching this milestone, look at how Bobo's situation changes. Before, when Bobo's account was always hovering near zero, it only took one small mistake to trigger a costly penalty. One day, he swiped his card to buy a coffee machine without realizing his balance was too low, and his account went negative by just $10. The bank immediately rewarded that tiny mistake with a $35 overdraft fee. For the bank, that is an extremely profitable transaction generated from a minor customer error. But once Bobo has $20,000 in reserve, that trap disappears. He no longer lets his account fall into overdraft, which means the bank gradually loses one of its easiest and most profitable sources of income. There is another reason this milestone matters so much. The financial system works most profitably on people who are always living on the edge, like the old Bobo. In the past, whenever his car broke down or a medical bill showed up, Bobo had no choice but to use a credit card and make only the minimum payment each month. Banks love that kind of customer because they can collect 20% to 30% interest year after year. But now, with $20,000 set aside, Bobo can pay for emergencies in cash. He may still use credit cards for convenience or reward points, but he pays the full balance every month. At that point, Bobo is no longer a goldmine of interest payments. He has become the kind of smart customer who uses the system without letting the system profit heavily from him. More importantly, $20,000 gives Bobo something even more valuable than money: time to think. Before he had savings, every financial decision he made was pushed by urgency. He once rushed into a high-interest phone installment plan simply because he needed a device immediately for work. When people are under financial pressure, they often agree to terms they would normally reject without hesitation. Now that he has money in reserve, Bobo is no longer forced to act out of panic. He has time to compare banks, negotiate rates, or simply say no to unreasonable insurance add-ons and costly financial packages. That freedom of choice and the calm that comes with it transforms Bobo from someone who has to buy money at an expensive price into someone who controls financial tools on his own terms. And that is the real reason this milestone matters so much. Bobo's safety, patience, and clarity are in many ways the system's lost revenue. That is why the financial world may be happy to hold your money, but it does not necessarily want you to reach the point where you no longer need to depend on it. How banks make money from people who have not reached the $20,000 mark. From all of these traps, fees, penalties, and interest charges, we can see a clear pattern. When someone does not yet have a strong financial cushion, they lose not only money, but also peace of mind. When an account is always close to empty, every decision becomes stressful. And in that exact state, Bobo unintentionally becomes the ideal target for the financial system to extract profit from even the smallest mistakes. The first trap Bobo repeatedly falls into is the overdraft fee, a kind of punishment for being short by just a small amount of money. For example, imagine Bobo has only $20 left in his account, but accidentally swipes his card for a $25 payment. Instead of declining the transaction, the bank allows it to go through and then immediately charges Bobo a $35 overdraft fee simply because his account went negative by $5. The result is absurd. Bobo is already short on money, yet now he is burdened with a penalty far larger than the amount he was missing in the first place. That is the paradox of the modern financial system. The people with the least money are often punished the most. A small slip-up becomes a highly profitable and recurring revenue stream for the institution. At the same time, without a $20,000 emergency fund, Bobo is forced to use his credit card as a lifeline to cover essential daily expenses. But because he does not have enough cash to pay the full balance at the end of the month, he can only make the minimum payment required to keep the account active. That is when credit card interest begins to show its real power. High interest charges pile up month after month, making each new statement larger than the one before. Bobo is now like someone running on a treadmill, working harder and harder every day just to keep up with the interest, while never truly touching the principal. Meanwhile, people who already have cash reserves use the very same credit card to earn reward points, collect perks, and pay no interest at all. This lack of savings also pushes Bobo into desperate borrowing, where he has to buy money at the most expensive price in the market. When an emergency happens, like his car breaking down and he does not have cash available, Bobo is cornered. He may rush into fast loan services or sign high-interest contracts simply because he needs transportation to get to work the next morning. And in finance, people who are desperate usually lose the power to choose. Once that power disappears, they almost always end up paying the highest price for their hardship. By contrast, someone with a cash reserve can face the exact same emergency very differently. If the car breaks down, they simply transfer money from their $20,000 savings and solve the problem without paying a single extra dollar in interest. Finally, even when Bobo tries to hold on to his money, he still faces quiet, ongoing losses through maintenance fees and small account charges. Because his balance is too low, he may fail to meet the bank's minimum requirements and end up paying monthly account maintenance fees, ATM fees, or other small recurring charges. In practice, these fees tend to hit low-balance customers far more often. When an account is constantly near the bottom, even a few small charges repeated every month can silently erode what little money is left. And over time, Bobo's financial struggle becomes yet another stable source of profit for the system. How to reach the $20,000 mark. To stop being easy prey in the eyes of the financial system, Bobo realizes he needs a concrete strategy to build his own $20,000 fortress. Instead of waiting for a miracle or an unexpected windfall, he starts by changing the smallest habits in the way he uses money every single day. The first step is facing his daily spending honestly. Bobo sits down and reviews every bill, every bank statement, and every small expense as part of a full financial audit. He figures out exactly how much money he truly earns each month and how much he is actually spending on essential needs. Because once he looks directly at the numbers, he begins to notice that the real leaks are often the invisible ones: unused subscriptions, impulse purchases, and little habits that quietly drain his ability to save. Once Bobo finds even a small surplus, whether it is $50 or $100 a month, he immediately puts an automatic saving system in place. The moment his paycheck hits his account, a fixed amount is transferred straight into his emergency fund before he even has the chance to see it or spend it. He treats this money like a mandatory bill owed to his future self, ranking it above new clothes, entertainment, or social spending. That simple system helps him build financial discipline without having to fight temptation every day. To speed up the journey toward $20,000, Bobo also learns to take full advantage of extra income. Instead of using his year-end bonus, tax refund, or side hustle earnings to reward himself with an expensive gadget or unnecessary luxury, he puts all of it directly into his emergency fund. Every extra dollar added to that reserve is one more step away from the grip of bank fees, penalty charges, and high-interest debt. And if his monthly gap is too small, Bobo actively works to increase his income by improving his skills or taking on extra work, turning spare hours into bricks for a stronger financial foundation. He accepts that reaching $20,000 means cutting away what matters less in order to gain something far more valuable: peace of mind. That kind of money is not built through one dramatic moment. It is built through hundreds of small, correct decisions repeated over time, choosing to cook at home, choosing to repair something old instead of replacing it, and staying loyal to the goal no matter how slowly progress comes. As the balance in his account grows, his fear of surprise fees and crushing interest slowly fades. In its place comes the confidence of someone who is no longer being controlled by money, but is gradually taking control of the entire game. What happens when you have $20,000, and how your mindset begins to change? Once Bobo reaches $20,000 in savings, his position in relation to the financial system begins to change in a very visible way. Before, Bobo lived in constant day-to-day survival mode. Every financial decision came with the same fear. If something goes wrong, where will the money come from? If I fall short, who will I have to borrow from? But once he builds a meaningful cash reserve, Bobo gradually steps out of that survival mindset. In its place, he gains a quiet but powerful form of control: the ability to say no. That change becomes obvious in the way he handles outside pressure. For example, imagine Bobo is being unfairly yelled at by his boss, or forced to work unpaid overtime in a toxic environment. In the past, when his bank account was nearly empty, he had no choice but to endure it. Losing his job would have meant not having enough money for rent the following month. But with $20,000 behind him, Bobo becomes calmer and more steady. He now has enough financial support to live for at least several months if he decides to walk away. That savings cushion becomes a kind of support stick, allowing him to stand up straighter, reject bad options, and wait patiently for a better opportunity instead of grabbing the first unstable job just to survive. This confidence helps Bobo shift from a scarcity mindset, where he constantly fears loss, into a proactive mindset, where he sleeps better at night, because he knows he is no longer one unexpected bill away from being cornered. In the end, the greatest value of $20,000 is intellectual freedom. When the mind is no longer consumed by the question of how to survive next week, it finally has room to think about how to build wealth. Bobo can now spend time learning new skills, studying long-term investing, or planning a small business. He is no longer just defending himself against bank fees, penalties, and financial traps. He has stepped into a new role, someone who uses money as a tool to serve life, rather than living as a servant to money. So we can see that the $20,000 milestone is the first real turning point in the financial game. Before reaching that number, most people live in a defensive state, constantly scrambling to deal with bills and unexpected setbacks. But once they cross that line, they begin to gain enough breathing room to live more intentionally and make decisions from a place of stability. Banks are not truly afraid of you having money. What they dislike is you becoming financially secure enough that you no longer fall easily into fee traps, high-interest debt, or rushed decisions made out of desperation. Every dollar you consistently place into savings is a small step towards standing more firmly on your own feet and becoming harder for the financial system to profit from through your mistakes, your fear, or your lack of options. Reaching $20,000 in savings marks a major turning point. It is the moment you begin moving away from the position of prey inside the financial system and toward the position of someone who is in control of their own money. That is why building your emergency fund matters so much. Start today, so that the decisions you make in the future come from freedom and calm, not from panic and financial pressure.